Right now, the average American family has more of their money in the stock market than at any point in recorded history. And the market itself is more expensive than it was right before the 1929 crash. Those two facts have never been true at the same time, until now. Now let me show you what I mean. There's a measure called the CAPE ratio. It tracks stock prices against a decade of earnings, adjusted for inflation. It's been calculated for about 145 years, and in all that history, today's reading has only been exceeded once. In December 1999, right before the dot-com bubble burst. You've probably heard some version of that before. Markets are expensive, valuations are stretched. Pundits have been saying it for years, and they're not wrong. But here's what nobody's showing you. At the bottom of the 2008 financial crisis, the worst crash most of us have lived through, American households had about 19% of their financial assets in stocks. 19%. That was the floor, the moment of maximum pain. Today, that number is 47%. The market is nearly as expensive as it's ever been, and you've never had this much of your wealth riding on it. And by the end of this video, you'll understand exactly what that means for your retirement savings, why the same size crash would hit you harder today than it would have a generation ago, and what you can actually do about it before the next downturn hits. I've spent over 30 years watching markets do exactly this. Climb until everyone believes they can't fall, and then fall until everyone believes they can't climb. I've sat in rooms where we tracked these cycles in real time. The dot-com peak, the 2008 meltdown, the COVID crash. After a while, you start to recognize the pattern. But here's what I want you to understand before we go any further. This is not a video telling you a crash is coming. I don't know when the next downturn hits. Nobody does. And anyone who tells you otherwise is selling something. What I can tell you is that the ground beneath your retirement savings has shifted in ways that most people haven't noticed. $9.9 trillion sitting in 401k plans alone. That's not Wall Street money. That's your money. Your paycheck contributions, your employer match, decades of compounding, all of it now riding on a market that looks like it did right before the two biggest crashes in modern history. And the question this video answers isn't whether the market will crash. It's a much more important question: why the same crash would hurt you more today than it ever would have before. But to understand that, you need to see one number, a number that most people have never heard of, but that quietly changed the rules of the game. And that number starts with a question: who's actually holding the risk? Let me take you back about 40 years. If you worked for a decent-sized company in the 1970s or 80s, retirement wasn't something you worried about. Your employer had a pension, a defined benefit plan. You showed up, you did your job, and when the time came, the company sent you a check every month for the rest of your life. The market could crash, interest rates could spike, the economy could fall off a cliff. Didn't matter. That was the company's problem. They managed the investments, they took the risk, and they guaranteed the payout. You were under a concrete roof. I remember early in my career talking to guys who were getting ready to retire. And you know what they never talked about? Their portfolio. Their asset allocation. They didn't have to. The company had it covered. That was just how it worked. And then it changed. In 1978, a provision tucked into the Revenue Act created something called Section 401k of the tax code. It was designed as a supplement, a little extra on top of your pension and Social Security, a savings bonus. But employers looked at it and saw something else, a way to stop guaranteeing retirement, a way to shift the risk off their books and onto yours. And it worked. By 2016, nearly 3 out of 4 American workers had a 401k and no pension. The concrete roof was gone. Now, here's why this matters for what we talked about in the opening. Think of it this way. Imagine a storm is coming. Same storm, same wind, same rain. But in the old system, you were inside a building. The employer held the roof. Your stuff was dry. In today's system, you're holding the roof yourself. And here's the part nobody tells you. You've moved most of your furniture outside. In the first quarter of 2009, at the absolute bottom of the financial crisis, American households had 19% of their financial assets in the stock market. That was the worst moment in a generation. Today, 47%. Let me say that again, because I want this to land. At the peak before the 2008 crash, when everyone thought markets were bulletproof, households had about 33% of their financial wealth in stocks. That was considered high. At the bottom, after the crash destroyed trillions, it was 19. Right now, we're at 47. That's not just higher than the bottom, it's higher than the peak, by a wide margin. Same storm, same percentage drop. But because you're holding so much more of your life's savings in the market, and because there's no pension guarantee behind you anymore, the damage hits a much larger share of everything you have. The storm didn't get worse. Your roof got thinner. Now, there's a much deeper story behind how this shift happened, how a tax code loophole from 1978 became the retirement system for 70 million Americans. But that's a story for another day. But if this is starting to make you think differently about your own retirement savings, subscribing means you won't miss what comes next. Now, you might be thinking, okay, but smart people on Wall Street say these valuations are perfectly justified, that the world has changed, that this time really is different. And here's the thing, they might be right. But even if they are, it doesn't change the math I just showed you. Let me explain why. So let's be honest about something. There are very smart, very credible people who look at this market and say, it's fine. And there are equally smart, equally credible people who say, it's not. I want to show you both sides, because you deserve to hear the full argument, not just the scary half. Let's start with the cautious camp. In October 2024, Goldman Sachs projected that the S&P 500 would return just 3% a year over the next decade. 3%, barely above inflation. Their reasoning? Market concentration at the highest level in 100 years, with a handful of tech giants driving the bulk of returns. Now, a year later, they revised that up to 6.5%. Still below the long-run average, but a very different number. And that's worth noticing, because it tells you something important. Even the experts aren't giving you a fixed answer. They're giving you a moving estimate. The Federal Reserve's Financial Stability Report from November 2025 flagged equity valuations as elevated, with the equity risk premium well below its historical average. And there's the concentration problem. In 2024, the Magnificent Seven stocks accounted for 53% of the entire S&P 500's return. 53% from 7 companies out of 500. So that's one side. Valuations are stretched, returns may disappoint, and most of the market's gains are standing on a very narrow ledge. Now, the other side. Jeremy Siegel, professor at Wharton, one of the most respected voices in finance, has argued for years that the CAPE ratio is misleading. His case is straightforward. After the 1990s, accounting rules changed. Companies started taking bigger write-downs, which pushed the trailing earnings in the CAPE formula lower and made the ratio look higher than it really is. His headline evidence? Between 1981 and 2015, the CAPE ratio signaled overvaluation in 416 out of 422 months. If your smoke detector goes off every single day for 34 years, at some point you stop calling it a warning and start calling it a malfunction. Academic research backs up part of this. A 2023 study found that CAPE's ability to predict returns 1 year out is essentially zero. It may tell you something about the next decade, but it tells you almost nothing about the next 12 months. And then there's the AI argument. Some analysts believe that artificial intelligence is about to drive a sustained jump in corporate earnings, and if that happens, today's prices could look perfectly reasonable in hindsight. Goldman itself noted that some classic bubble features are absent from today's market. So who's right? Here's my honest answer. I don't know, and neither does anyone else, not with certainty. But here's what I do know. This entire debate is about the price. Is the market too expensive? Is Kate misleading? Will AI justify these valuations? It's a debate about whether the referee made the right call. But your problem isn't the call. Your problem is the size of your bet. Whether this market is perfectly valued or dangerously overpriced, the fact remains, American households have 47% of their financial assets riding on the outcome. That number isn't disputed by anyone. Not by the bulls, not by the bears, not by Siegel, not by Schiller. And the Bank for International Settlements said it plainly in their 2026 report. Because household equity exposure has grown so much, a major correction today could produce, and I quote, more pronounced wealth effects and sharper consumption pullback than in the past. Now, in fairness, a recent Federal Reserve study from August 2025 offers a partial counterpoint. Because stock ownership is so concentrated among the wealthiest households, the average family's spending may actually be less sensitive to market swings than the raw numbers suggest. That's a real argument, and it deserves weight. But here's what it doesn't change. If your 401k is your retirement plan and nearly half your financial life is in equities, the concentration of wealth at the top is cold comfort when your own balance drops $150,000. The referee can argue all day. The size of your bet is still on the table. So here's the part that actually matters to you. Because everything I've shown you so far means two completely different things depending on where you are in life. If you're 5 years from retirement, the math works one way. If you're 30 years from retirement, it works the exact opposite way. And most people don't realize that. I've sat across the table from people in both situations, folks who were months away from retirement, watching their savings shrink in real time, and folks in their 30s who had decades ahead of them and couldn't understand why everyone was panicking. And I'll tell you something, they were both right to feel what they felt, because the same market event means two completely different things depending on when you need your money. So let's start with those of you who are 55 or older, approaching retirement, or already in it. Think of your retirement savings like an airplane coming in for landing. At 30,000 feet, turbulence is uncomfortable. The plane shakes, your coffee spills, but you've got plenty of altitude to recover. But 5 minutes from the runway, that same turbulence is a completely different experience. That's what financial planners call sequence of returns risk. A big loss early in retirement, or right before it, is fundamentally different from the same loss 20 years earlier. Because you're no longer adding to the account, you're withdrawing from it, and a $150,000 drop on a $500,000 balance isn't a paper blip when you need that money to live on starting next year. And here's what the data shows. According to Fidelity's analysis of over 25 million retirement plan participants as of March 2026, half of participants age 70 and older hold a higher stock allocation than age-appropriate guidelines suggest. Half. And nearly 4 in 10 between 65 and 69 are in the same position. These aren't reckless people. Most of them probably haven't looked at their allocation in years. The market went up, stocks grew as a percentage of their portfolio, and nobody sent them a warning letter. They're 5 minutes from the runway, and they're carrying more turbulence risk than they realize. Now, if you're in your 30s or 40s and you're watching this thinking, this is terrifying, hold on. Because for you, the exact same math tells a completely different story. Yes, if you're under 45, you probably have around 90% of your 401k in stocks. That's the highest of any age group. But you also have something that the 55-year-old doesn't, time. And something else that's even more powerful, automatic contributions. Every 2 weeks, money comes out of your paycheck and goes into your 401k. When the market drops, that same contribution buys more shares at a lower price. It's called dollar cost averaging, and it's not a strategy you have to think about. It's already built into the system. Fidelity and Morningstar have both studied what happened to people who kept contributing through the 2000 and 2008 crashes. The result? They came out ahead of the people who tried to time their exit. For your age group, the real risk isn't the market dropping. The real risk is what you do when it drops. If you panic sell, or if you stop contributing because the headlines scare you, that's when you actually lose. That's when you take a temporary decline and turn it into a permanent setback. So whether you're close to retirement or decades away, there is one thing both groups need to do, and it's simpler than you think. So let's bring this home. At the beginning of this video, I told you that by the end, you'd know exactly where you stand. So let's make sure you do. Here's what we've established. The stock market is sitting at its second highest valuation in 145 years. American households have nearly half their financial assets riding on it, more than ever before. The pension safety net is gone for most workers, and the same size crash that hit in 2008 would now land on a much larger share of your personal balance sheet, with no employer guarantee behind it. That's the picture. Now here's what you can do about it. Step 1, and this is the most important, log into your 401k and look at your actual equity percentage. Don't guess, don't assume. Look at the real number. You might be surprised. Step 2, compare that number to an age-appropriate benchmark. Target date funds are a reasonable yardstick. If you're 60 and you're sitting at 75% equities, that's worth understanding. Not panicking over, but understanding. If you're near retirement, think about whether a 1 to 2 year cash reserve makes sense for your situation, enough to cover withdrawals without being forced to sell into a downturn. That's not a recommendation. It's a principle that most financial planners would recognize. And if you're in your 30s or 40s, the single highest leverage move you can make is the simplest one. Keep contributing. Through the dips, through the headlines, through the noise. That automatic contribution is doing more heavy lifting than you think. What none of this means is selling everything and running for the exits. Diversification and periodic rebalancing. That's the evidence-based response to elevated valuations. Not panic, not market timing, just knowing where you stand and making sure it matches where you're headed. The storm may come, or it may not. But now you know how much of your roof is exposed. And that knowledge is the first step toward making it stronger. If this helped you see your retirement savings in a new light, do me a favor, hit subscribe, and share this with someone you care about. Because the people who need to hear this most are usually the ones who aren't looking for it. And if you want to keep building that kind of clarity around your money, I've got other breakdowns on this channel that go just as deep. Pick one that catches your eye. I'll see you there.